Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday the 4th of April in London. I'm Stephen Carroll. Coming up today, Jerome Powell says the Federal Reserve still has time to assess more data before deciding when to cut interest rates. Apple explores personal robotics as the next big thing after pulling the plug on plans for an electric car. And after Credit Suisse comes the clean-up. We look at the sweeping changes Switzerland is making to bank regulations to avert another collapse. Let's start with a roundup of our top stories. The Federal Reserve Chair Jerome Powell says the central bank has time to wait for more data before cutting interest rates. In a speech at Stanford University, Powell reiterated that it will likely be appropriate to begin lowering rates at some point this year. However, the Fed chief also said the recent bump in prices didn't alter their broader trajectory.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Powell's prepared remarks echo those he made following the March meeting. They also suggest the Fed is unlikely to reduce rates at their next gathering at the end of the month. Gold has hit another record on the likelihood that the Fed will cut interest rates this year. The price of the precious metal topped $2,300 an ounce, with investors betting that it stands to benefit from the impending pivot by the US Central Bank. Senior commodity strategist at ANZ, Daniel Hines, says the rally has surprised many.
Look, it looks pretty strong, but in saying that, in my experience, these type of rallies tend to end quite unexpectedly. So I would be looking for a bit of a pullback at some point over the next month or two. But, the extent of that, I think, should be relatively limited. There's still plenty going for it over the medium term.
Daniel Hines' analysis comes as the latest data compiled by the World Gold Council shows central banks continued to add to their holdings of the metal in February, albeit at a slower pace than before. The United Nations has put night missions in Gaza on hold while charities review their humanitarian work there after 7 World Central Kitchen aid workers were killed in an Israeli airstrike. The decision comes as US President Joe Biden and Israeli Prime Minister Benjamin Netanyahu are scheduled to speak by phone today. The Israeli military's chief of staff, Herzi Halevi, says the strike was a mistake.
The strike was not carried out with the intention of harming WCK aid workers. It was a mistake that followed a misidentification at night during a war in a very complex conditions. It shouldn't have happened.
However, Herzi Halevi's account has been disputed by Jose Andres, the founder of World Central Kitchen. In an interview with Reuters, he said the aid workers were targeted, quote, systematically, car by car. Vladimir Putin is now focused on achieving his war goals after securing another 6-year term in power. The Russian president has stepped up missile barrages at Ukrainian cities and is planning to form 2 new combined armies. But a breakthrough will be challenging for either side, with Russia short of manpower and Ukraine running low on ammunition. NATO's Secretary General Jens Stoltenberg says the alliance is doing what it can to help Ukraine.
We are transforming NATO's comprehensive assistance package into a multi-year program of assistance. We are helping Ukraine move closer to NATO standards on everything from procurement or logistics. And we are supporting Ukraine's reform efforts to bring Ukraine ever closer to the alliance.
NATO's Jens Stoltenberg speaking there. Meanwhile, Ukrainian President Volodymyr Zelensky signed a bill this week to lower the age of wartime conscription to 25 from 27 as his military seeks to replenish its depleted ranks. Barclays has kept a cap on bankers' bonuses in place despite the ceiling being lifted by UK regulators. Bloomberg's Tiwa Adebayo has the details.
The UK government has scrapped its banker bonus cap in a bid to make post-Brexit Britain a global financial hub. But it seems like Barclays hasn't gotten the memo. Additional payment at the lender is still restricted at a maximum of 2 times one's base salary, according to a letter to shareholders. Chairman Nigel Higgins says the policy is in line with Barclays' focus on rewarding sustainable performance, but his words are unlikely to reassure staff, some of whom received no bonus at all last year. The bank's failure to budge on the matter highlights the challenges faced by lenders attempting to revert to pre-bonus cap payment structures. In London, Tiwa Adebayo, Bloomberg Radio.
Apple is exploring a move into personal robotics. Sources told Bloomberg the tech giant's engineers are looking for the next big thing after cancelling its major EV project in February. Bloomberg's Mark Gurman explains what Apple is working on.
A few years ago, they started development of what is essentially a large iPad on a robotic arm that can move on a FaceTime call to follow a user. So let's say you and I are FaceTiming and you have one of these devices and I tilt my head or nod my head or some such. The display that you're seeing would nod or move around to mimic my head movements on that robotic arm.
Shares of iRobot, a possible M&A target, rose by 17% after Bloomberg broke the news. The potential new venture comes as pressure on Apple grows to find new sources of revenue beyond the iPhone. And the UK government is so far rejecting any taxpayer-funded rescue plan for Thames Water. Sources tell Bloomberg that ministers are pushing Britain's largest water company to find a privately funded solution. Bloomberg's James Wilcock has more.
The UK government are daring Thames Water's investors to blink first. It's a risky strategy. The company has been called uninvestable by its 9 main shareholders. They say with £18 billion of debt, worth 80% of the utility firm's equity, that they're not stumping up any more money for it. In the tight fiscal environment, no politician of any party wants to pay a penny for what they see as a disaster of private management. Meanwhile, Thames Water continues to burn through cash and public goodwill. Current estimates say it will run out of money in June 2025. The goodwill date may already have passed. In London, James Wilcock, Bloomberg Radio.
Now, in a moment, we'll get analysis on the Fed chair's speech, plus dig into the overhaul of financial regulation in Switzerland a year on from the collapse of Credit Suisse. But another story that caught our eye this Thursday, a billionaire saying he sees more of us moving to a 4-day week. This is Steve Cohen, the founder of Point72 Asset Management and the owner of the New York Mets baseball team. He made the comments in his first ever interview with CNBC. He says the rise of AI and hybrid working, which he believes makes people not as productive on Fridays, are some of the factors bringing us towards a 4-day week. Now, Steve Cohen is an avid golfer. He's even investing in the sport because he thinks people will have more time to play it in the future. But he did say that he wants his own traders and portfolio managers to keep working 5 days a week, because taking Fridays off when you have a portfolio, he says, would be a problem. Well, let's turn to our top story. Jerome Powell says it's too soon to say whether the recent pickup in inflation was more than a bump, and that he still expects to cut interest rates at some point this year. The Fed chair speaking at Stanford University. The highlight of a week that's seeing more than a dozen speeches by policymakers being parsed for clues of when interest rate cuts will begin. Joining us now to discuss is Bloomberg opinion columnist Daniel Moss. Dan, great to have you on with us. Has Jerome Powell then given us any useful clues as to the Fed's thinking on the rate path ahead?
Feels like we've had this conversation a lot the past few weeks. People keep looking for, a change of narrative from the Fed leadership. And thus far, hasn't happened. He said nothing at Stanford that is inconsistent with the idea of a couple or several cuts later this year. Nothing whatsoever. Yes, they can take their time, but there was never a rush. As soon as he started talking about this late last year, traders started getting fixated on March because that was when the next dot plot was coming out. But that always seemed like a stretch. So we're back to where we were, which is also where we should have been. He's right. They don't have to rush it, but it's going to come.
It was interesting, though, to hear Jerome Powell talk about other issues in this speech away from the rate path, and particularly the importance of the independence of the Fed and its apolitical nature. Why do you think he chose to talk about that in this speech?
Yes, it's interesting. It's particularly interesting that it's in his opening remarks. The rest of the conversation at the university was a sort of a fireside chat, a little less formal, a little less scripted. So he's looking down the track, 6 months, potentially the return of a president that has been hostile to the Federal Reserve. But more importantly, this is about the optics of how the Fed presents itself, particularly to Congress. Congress has been a little antsy, shall we say, about where some bank rules relating to climate and climate change might be going. Central banks in Europe are pushing very hard for global standards that are more cognizant of climate risks. The Fed is saying, well, no, we don't have a mandate for that. You know, we're apolitical. We don't have a mandate for this. We don't have a mandate for fiscal policy. We don't have a mandate for immigration. It's all about what they don't do. Kind of selective, in my view, and it's a reading of the political temperature. When the Fed overhauled its policy framework in 2020, they broadened the way they spoke about the labour market. They were talking about issues of equity in the labour market. So we're seeing them kind of, you know, when the overall climate is sympathetic to a little more policy adventurism or policy reinterpretation, they can certainly do that. Clearly, this is not something they see right now.
Tanya, thinking about the data too, you've been writing recently about how we should be taking some positivity from good news rather than necessarily reading good news as bad news. Talk us through your piece.
There are a lot of long faces around. And, you know, the proximate cause for the hand-wringing this week was the first expansion in US manufacturing since 2022. I'm talking about the release of the ISM number on Monday. And that was the latest, good news is bad news, because we're going to push back market projections of when the Fed may ease. But, okay, look, it's the first positive reading in close to 2 years. And also, let's not be myopic about this. The US, as significant as it is, I've said that a lot on this show, but it is not the only game in town. Okay, we saw earlier in the week a meaningful uptick in manufacturing in China. We have seen in the past week some extremely bullish export numbers from South Korea. South Korea, big node in the global manufacturing scene, particularly relates to tech. We had good PMI numbers from Taiwan and from Japan. Look, if the US does not have to carry the world economy on its shoulders, how can that be bad? How can that be bad?
Well, indeed. Bloomberg opinion columnist Daniel Moss, thank you very much for joining us with your analysis. Now, a year ago, the collapse of Credit Suisse cast into doubt Switzerland's hard-won reputation as a stable place to put your money. Years of light-touch regulation had failed to stop the rot at the global investment bank. The country's regulators and politicians are now in repair mode, working to revamp the law and give its financial watchdog powers to intervene much earlier in the game next time. Our European finance editor Jeff Black joins us now for more on this story. Jeff, great to have you on. What are the fundamental problems into how the Swiss financial centre is run?
The fundamental quality, of course, of the Swiss financial centre for a very long time is that it's been very stable and run in a sort of self-regulating way. And that worked very well for a long time. It didn't work well, however, when there was a big institution that had a lot of cultural and structural problems inside it. And the simple fact was that over a number of years, everyone outside of Credit Suisse was more or less powerless to change anything that was going wrong, even if they could see things going wrong. And that was what the position of the regulator, FINMA, was. And that kind of blew up the old consensus-based system because Credit Suisse fell apart.
So what are the changes being put in place now then?
They're quite far-reaching. On the one hand, there's pretty much broad support to give FINMA much greater powers to be able to hold the financial sector to account. And the major one of those is to be able to fine banks and other types of financial companies. It might seem quite amazing that FINMA does not have that power, which is pretty much standard all across other major financial centres, but it doesn't. But that is more or less certain to arrive now. And then one of the other major changes would be the introduction of a so-called senior managers regime, which means making everyone in a bank able to say who's in charge of what, so that when things go wrong, you know who's accountable.
So is everyone on board with this new plan then?
So, like I said, there is very broad support, including from the banks, for these major changes. The chairman of UBS, which is now by far the biggest bank in Switzerland, is of course one of the world's largest wealth managers. They broadly support both of those pillars. What they're not massively keen on, of course, is higher capital and liquidity requirements, and that's also a possibility that they could be getting special treatment in that sense.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.